I would like to sum up for 30 seconds what previous fellow panelists and distinguished guests have brought to this conference. Key points, and everybody knows that my panels are very pragmatic. We stick to the reality, what's in reality. I would like to start from a word used by Alex, the real opportunity. No matter what you're building, but if it's not attractive, it's meaningless. So the real opportunity is that. Key stats, there are, from our lovely economist, 700 companies that make more than $500 million turnover, and 400 to 500 companies that make more than 1 billion turnover. So think yourself what you're building. If you're building something that is more than $50 million, it is 5 to 10% of the large corporations' annual turnover. So how realistically is that it is an investment opportunity which would be very attractive? Think about this analogy, ladies and gentlemen, and let's open it up to the panelists. It's time for them to talk, not for me. So very simple question. What do investors really think about the opportunity in Africa? Mohammed.
It has to be different, Filippo. It has to be different. It has to be attractive. And the place that we invest, they have to have the right investment codes or investment package for the outside investors to come into Africa. As you know, we have a couple of investments in South Africa, and we recently invested here in Rwanda, which I hope it will not stop there.
Rahul.
Thanks, Filippo. I come more from an Asian investor perspective, and we've been in the hospitality industry now for over 20 years. And our strategy has typically been to enter markets that have successfully come out of conflicts. And some of those markets that we have entered are Sri Lanka, where we entered right at the peak of the conflict, and even Sri Lankans were not willing to invest in Sri Lanka itself or the neighboring market like Maldives. Similarly, for an Asian investor, whereby a lot of the discussions before covered aspects such as your interest rates, your costs, your tourism influx into the country or the region, we felt that East Africa, that's where our group's focus is. We felt that East Africa in the long run is moving towards the stability, and we felt that there is a advantage here from entering the market, because you still have opportunity from the bigger brands also entering these markets, whereby we have our own brand. We are in India, and our good friends from Sarovar are also here. So we felt that there is a huge first mover advantage here. Apart from that, we felt that the rates that you're able to command in this market, as against the interest rates as well as the development costs, are much more attractive than our part of the world. For example, in India and Nepal, you're talking about interest rates of almost 10 to 13%. And I was just talking to our friend from Propaco, and he was telling us about how they're planning to enter into the market, also assisting the developers from the cost perspective. So there are a lot of different aspects. So one can imagine, we are a company based out of Nepal, and we are all the way here in East Africa. There must be something that is differentiating that has brought us here. And we have our first hotel that is operating in Kigali, where CG Hospitality Holdings is a representative in the company which holds majority. And we hope to grow in this region. And we have a strategy of 5 countries here. And as we move along, I'm sure that all of those hotels can integrate as one.
If I may add to this, and then moving on to Nicholas, our friends, the good best friends, the debt provider, the one that gives us the money. But you as an investor, what kind of yield are you looking at? I'm very pleased you mentioned East Africa, because we've been involved in some transactions in East Africa, and different tickets, one above $50 million, one between $15 to $20 million. What kind of yield is CG Corp Global looking at when you invest in Africa? What kind of returns are you looking at?
Well, I'll answer that from a different, I'll answer more from the IRR, from an equity and debt IRR perspective. typically CG Hotels and Resorts, which is a part of CG Corp, any investment we look at in our part of the world, we look at anywhere between 10 to 15%. And we feel that's exactly why we're in East Africa as well, because we feel that getting that IRR return in this market is doable. And I guess it's with time to see that the hotels that we are here to stay. So the hotels that we intend to develop will get to that point.
Nicholas, from a debt point of view, we heard Rahul was talking about, I like this 10-15% internal returns. You know, you as a debt provider, you know, I mean, how many of these healthy returns do you find in Africa? And you know, I mean, what are you looking for? What kind of opportunity are you looking for as an investor of that?
It depends of the time, you know, because for this return, it takes a long time, because the construction of the operation, even if a brownfield or a greenfield project, those projects takes time. An average of 4 or 5 years between the started of all the study and the end of the building of the construction. That's why I think for the investor there's an important impact at the beginning of the financing. But for us as a development bank, we think that it's important to help and to finance those projects in the long term, and that's why our proposition is a good combination with a local bank, because we can provide some long-term debt in order to finance and in order to be really in line with those projects.
Nizar, how is the situation in Angola? You know, I mean, how do you see the investments, and what was the sentiment?
I think there is enough media out there which portrays every different country. I think to pick from Mohammed and Rahul and Nicholas here, we started this journey about in 2010. We are a family business in Canada, and like what Rahul said, that we are all here to make money. We look at the statistics, everything looks very rosy, but the reality on the ground is that there is work, there is relationships to be made, there is respect to the culture, there is respect to the employment of and building the Africans' living standards to bring them up, and one has to have a long foresight. For us, we picked up Angola. At the time was in 2014-15, we hired the right consulting companies to partner with us to ensure that we were getting the right direction. Our strategy was a long-term strategic approach. It was geared towards going after the hospitality market, to becoming our foundation, bedrock for us and for the country that we would get involved with. As for in Angola, as we know, the economy is a very strong economy. It's oil-based economy, but recently the prices have not been as fruitful. We also look very carefully from a point of view, like from what Rahul said, East African market. East African market, you have now, it's a mature market. It's probably 30 years ahead of Angola. We wanted to get into the market, which was the most difficult market to get in. If we went into Africa 30 years ago, where would we be today? And so we started looking at pockets in Africa, and our entry to market, we felt strong that the government of Angola was in the right direction. They are diversifying their investment strategies from an oil-based industry into a multi-sector industry. And our families have invested in Angola in a multi-sector approach. And from a hospitality standpoint of view, we have started we have finalized our arrangements with a major brand, and that will be the anchor of our development and our strategy in Angola. So currently we are actually building a mixed-use development, and that allows us to cushion some of the initial costs of starting up a hotel.
So in our experience in the last 12 months involved with transactions, and again, only in East Africa, is that the $15 to $25 million bracket seems to attract the huge amount of interest among the investment community, domestic and international. When we go above the $35 million as an investment from an existing asset, it becomes very challenging. It becomes very challenging because even with an existing asset, banks are nervous about lending, despite having a history and so forth. So let's link this kind of our own opinion and experience and that with what Alex and the economist said before about the potential for brands on the middle range, select services, the Hilton Garden Inn, Park Inn, Avani from the Minor Group, Ibis, Novotel. So all these kind of ranges, Courtyard by Marriott, to stimulate the investment appetite from people. Where do you see, more interest, in your opinion, in terms of the investment? Also from a debt point of view, it would be interesting to hear your views, your approach to different kinds of scale of investment. But I would like to ask Mohammed first, because Mohammed, you have one of the finest brands in the world in your portfolio. You are the one and only of these days. You have a lot of lodges. You have the Atlantis brand, which is, we're talking huge mega developments. What's your views about my statement about the money range?
It's with the two different brands, again, we're attracting two different segments of people completely. I mean, if we are talking about the Atlantis, of course, it needs huge capital. And the airlift to that city, to that town, has to be super. Otherwise, you cannot get the mass to come there. And in terms of one and only, it's very, very exclusive brand. I mean, we are putting two here in Rwanda, and issue comes in terms of raising capital in these markets. And not only that, but then the cost of debt, how much is it? I'll come back to my friend here, but double-digit return on investment, I think we are all looking at it. Otherwise, we cannot cover the cost of money.
But with a unique product like yours, is there an investment appetite there for this kind of product?
Oh, absolutely.
You're very unique, and you go into unique places, and brands like Atlantis may shift an economy, may shift the fate of a country, bringing attractiveness. Perhaps different investor profile.
It's a totally different investment profile. I mean, we are opening one now in China, in Sanya. Hopefully, we'll open it February, March next year. It's an Atlantis brand, but it's again huge, and the investor has to work with us, and we have to work with them. And of course, both the investor and the operator, they have to be absolutely flexible with each other when it comes to that solid mega brand. Again, one and only is different. It's very exclusive, very niche. It's very targeted.
So an horizon longer is not a cash flow; it's a more asset appreciation.
It's more of a long-term marriage. Much longer. It's not a couple of years return on investments. No, it takes longer than that.
Nicholas, your view, providing that the different kind of ticket prices, as we call it.
Yes, of course. When it's a huge project like in an upscale brand, of course, it's a more capitalistic asset. It needs more equity and more debt. But in East Africa, we are also looking for a middle brand, because I think this segment is more attractive first, and not really structured, or with a lot of unbrand market. That's why, for us, it's we are looking like a debt provider at the sustainability of the business plan. That's why we try to provide some long maturity of the loan in order to help the sponsor and to help the brand to attain the ramp up and the exploitation level.
But sorry, let me take it from there. I have had the experience and privilege to work with Propaco over the last 2 years. They don't just look at the project itself. They look who is behind. They look at the country. They look at the relationships of the country. They provide intelligence to make sure that you're on the right track to doing business. Although he hasn't signed our check yet, but hopefully we will soon.
Yes. Of course.
It's interesting, let's park this about who's behind. This is very important, but I would like to hear from Rahul about the mid-market sector as an attractive investment opportunity.
Actually, our investment strategy has been that with our own brands, that is our Zinc and Fern and Beacon brands, that we want to be in the 3 and 4 star space. We do not want to be in the luxury space because we feel there are a lot of big players like Mohammed already out there, and we feel that whichever market that we've stepped into, our strategy has been to enter in this segment itself. Also, I will add to that, you know, we started off in India about 12 years back, and we actually burnt our fingers very badly because we decided to get into development mode. And I was discussing with Nicholas there that by the time, I mean, the Indian development scenario and market is such that by the time you get your approvals and your property is up and running, sometimes the entire market dynamics have changed. So now we've come to a situation where we are clear that we want to be in all these new markets in the 3 and 4 star space, and we would like to focus on brownfield and distressed assets, because I feel that the faster you can get the properties operational, it's more appealing perhaps to the financiers as well, and also to the investors from the return perspective.
But you're very involved. Please, Nicholas, you were.
Just to confirm, in fact, Proparco are also looking who is a sponsor, because this is a key person for us. Because if you have some economical problem, political problem, this is a sponsor. We will be the key person in order to reimburse the debt that we have provided. That's why, for us, that's a key point, and that's different. We have two different kind of intervention. The first one, it's integrated group like Rahul, like or Telium or Serena. That's kind of group, or the interest of the sponsor and the brand are on the same line. And after, you have also another mechanism with a local sponsor and international brands. That's two different aspects also.
Let me add one more question to that, to you, which is very interesting. So the profile of the entity they're going to borrow the money. Mm-hmm. So I want to ask you twofold question. Number one, what are the common practical challenges that you, as a debt provider and investor with debts, find in lending money? What typical, were people failing to deliver in order for you to release, you know, the offer? And secondly, what I want to ask you is this. Yesterday we had an interesting discussion at the round tables, and for those that missed, it was a very thorough session about financing. It appears that the majority of lenders take into consideration the land as an equity contribution only up to 15%, because it is kind of a safe, you know, assumption when they're lending, even though sometimes even more than that, but they will only account 15%. My question is, you know, I mean, by doing that, is a kind of a too cautious approach? It does not allow, you know, those opportunities to flourish, or why they tend to take this, you know, approach? You know, so twofold question on that.
Yeah, we work with this both approach. You know, 1 month ago we signed with a local sponsor in Ethiopia with Accor for a new hotel. But last week we signed also with the Mongalese group Telium in Niamey for a new hotel also. We can work in the two approach, but I think the timeline is also different between these two kind of components. But we are, at that time, we are comfortable with these two solutions.
So, and the question, you know, I mean, I would like to give this audience some of the challenges you're facing when lending money. Where is, from a due diligence point of view, the people fall short? They are not prepared. Please give this insight. It's very important for this audience.
Yes, first, it's important to know who is a sponsor and to the importance of the land. But when we are analyzing during the due diligence the global cost of the project, we analyze without the land in order to know what is the capacity of the sponsor to put money on the transaction.
So long story short, you need to have the money, independently whether you own the land or not.
You know, it depends. Yeah, of course, it's important because after the construction, after 3 or 4 years, after the construction, after the ramp-up period, when you are in the exploitation period, if you have, I don't know, any problem, it's important to have a good sponsor in order to help reimburse the debt. That's the key point for us.
Rahul, as a company, as an investor, what is the challenge of this kind of approach? I mean, obviously, you have a land which is being, discounted. You've been thoroughly checked about cash and so forth. I mean, what is the practical challenge for an investor like that? How do you make it attractive, to present, to sell it to the banks?
I think, it's a combination of different factors. For us, also, Mohammed also, I think, touched upon this. Any new market that we step into, it's always a big challenge for us coming in and being able to get project finance because, we are from Nepal. And Nepal, we would probably be the first Nepalese multinational that has gone out. But every time we step into a different country, the banks will ask the first question, as he's saying, what is going to be your source of capital? What is going to be your ability to pay? What is going to be, because if we have our own brand, we are established at the moment in India. We have over 45 hotels that we operate there. But what do we have outside of India? So the way that we typically come in and the banks get the confidence is from the fact of our larger group itself, from our other business activities that we do, and predominantly also from our, I would say, our success in the hospitality space spread across 20 different countries and many different brands itself, and starting off being a developer, but now we are an operator as well. So all these different factors, I think, play an important role whereby convincing a financier to be able to make sure that you are able to turn the property around. Another, I would say, important factor would be that, we were investors for almost 15 years before we became operator. So we know, respectfully, we know the pains of all the investors when dealing with brands, because investors are always looking for the bottom line. And so to be able to balance the investor's perspective with the operator's perspective, I think is very important from the banking perspective as well.
One final question to Mohammed, because I think, despite having the finest brands in the world, under your portfolio, it's probably, having heard what's been said before, it seems that the luxury market proved to be, the least convincing story for the banks. But what you as an executive of a wonderful company, what are you doing in order to stretch the brand, into more urban context? Because a one and only is also not only a name, but is also a feature of your locations.
Absolutely, yes, yeah.
So, how do you prepare yourself to tackle Africa, and try to stretch the brand in order to, be present everywhere?
Now, you touched on the urban brand. Well, hopefully we'll be announcing it quite soon. I'm not in a liberty to announce, but then there will be a location that we'll be signing very soon, and that will be the first urban brand for One and Only. Because we've always been focusing on the, nature resort and resorts. So in terms of raising funds, it's not easy. Because even if you want to raise funds, the cost of the debt will be very expensive in those markets. Because the lender needs a lot of security, from the investor and, here the investments that we have, it's both owner-operator. So it's not easy. We need to come into those markets with a solid security and a solid cash, which it doesn't help.
So solid is the key word. We have only 1 minute. Is there anybody that would like to pose a killer question? This for one of the gentlemen. A big tough questions. Come on, you know, I mean, they always tell us the good stories. One killer question to forge. They were prepared. They were vintage, so you know they know. And so let's keep a more softer question. I mean, just as the final 10 seconds. You as an investor, operator, and debt provider, where do you advise people to put their money, and what range to look at in order to say, stick to this, and everybody, you know, I mean, we entertain discussions. Mohammed, it's tough for you because there's no cheap one and only, but
it's, no, again, it depends what you want to get out of it. Of course, the return on investment is very, very important, and we spoke about the double-digit returns annually. But then if you wanted a short or a long-term investment, and that will be the driver in terms of selecting the location and selecting the operator and selecting being the investor itself. Very, very important. With our brand, it's a little bit medium to longer range. With other brands, I mean, a 3-year stabilized year, and you can put it out in the market.
Rahul?
As I said before, that I see immense opportunity here in East Africa. And that's why we've charted out a 5-country strategy for East Africa in Rwanda, Kenya, Uganda, Bujumbura, and Tanzania. I would say in the mid-market segment would be the most interesting for us as an investor. And within the investment horizon of 15 to 20 million, I think would be the sweet spot for investors like us.
Nizar?
Our strategy is very clear. The net benefit should not just be to the investor. We look at the country, we look at the people, we look at the resources they have, and we say, how can we partner, not with the ministers or the governments, how do we partner with the local entities which will create jobs, create high-paying jobs long term. And that's our strategy, is that not just from an investment point of view is how we can make money. We also look at it from a point of view is that what can Africa teach us? We don't come with the mindset that what we can teach them and how we can allow them to, so it's a partnership to find out how we can find those strategies. And those models of businesses are far and few. And so for our side, the investment we look at is not the 5-star or the resorts. We look at the 3 stars or 4 stars, which is the middle class economy, which is the fastest growing. So create employment starts from the get-go of the development. And we touched a little bit on land. Land is very, very important. Land laws are quite difficult in the African market, so one has to be very careful.
Great.
Sorry.
Very fast.
Yeah,
Last thought?
Properco is focusing on West and East Africa, all of them, with a project on the upscale or mid-scale project, brownfield or greenfield project, and with a good sponsor and good brand. And
Ladies and gentlemen, I'm really sorry, we are out of time. Thank you for your contribution. Please show your appreciation to our 4 wonderful panelists. Thank you. Thank you for the time. Thank you, Mohammed. Thank you very much.
Thank you.
Thank you, Rahul.